Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Wednesday, March the 11th, 2026. Okay, so let's immediately have a look and see what's going on. No surprises that the market remains firmly sort of focused on the situation in the Mideast with the oil and whatnot. We have a quick look here at volatility that remains very elevated. You see the VIX here, over the last, let's say, 48 hours, down from the crazy levels, but still in the mid-20s. So still very elevated volatility. Obviously, oil, OVX, still incredibly high. So volatility remains the name of the game. And essentially what we've been seeing, let's just look at the equity market here. Basically, you see what's happened overnight. This is the daily chart. And also yesterday, you can see that we've had sort of, quite choppy action and but essentially no resolution, neither sort of positive nor negative. And basically, what's happening is that the equity markets are essentially trading on the price of oil and the potential for resolution in the Iran-Israeli-US conflict. And at this point, we don't seem to have that. I won't go through all the headlines yesterday. There were all kinds of headlines that the US was able to escort tankers through the Strait of Hormuz. And then the Secretary of Energy said deleted that tweet. There was talk of mines being laid, which is negative. Obviously, there's all kinds of sort of headlines going on. But as far as I can see at this point, the big picture is that the Iranian regime still seems to be in place. There doesn't seem to be a huge amount of obvious internal sort of opposition, and therefore a relatively hardline stance is still being sort of portrayed and sort of communicated to the Americans. There's also the potential threat of mining the Strait of Hormuz. Trump, of course, has retaliated with bellicose rhetoric, essentially saying, there will be consequences. But at this point, the reality remains, we'll just look at a map here that, let me just pull up a map just to put this all into context, that the Straits of Hormuz remain essentially shuttered, except for Iranian-based or Iranian-linked oil tankers. They apparently are getting out still 1 or 2 million barrels per day. Now, what the Saudis have done, they're basically using the east-west pipeline here. So instead of going via via water, as you see here through the Strait of Hormuz, the Saudis are basically sort of piping apparently about 5 or 6 or 7 million barrels of oil to Yanbu out here on the Red Sea and getting things moving that way. So the other issue as well is that the UAE, rather than using sort of the water here, as you can see, they're using this pipeline here at Fujairah, which is going out to the Gulf of Oman. Apparently, the capacity is about 1.5 to 2 million barrels. So from what I can see in the research I'm doing, normally on a typical day, something like 18 to 20 million barrels comes through this sort of area. But with the rerouting, we're getting about 2 million on the Iranian tankers, about, let's say, 2 million coming through here, and about 6 or 7 million coming through here. So, and then there's a few sort of ships which are sort of taking the risk. So it seems to be that we're getting about 50% of the normal flow. So something like 8, 9, 10 million barrels per day are moving, rather than the 18, 19, 20 million barrels, which typically goes through. So what does that mean? That means that the overall situation is that the Americans and the Israelis are still at war with Iran, number one. Number two is that the Iranian regime is still in place and is still responding, albeit on a more modest sort of scale. But they have ramped up the threats with, sort of mining this area, which would be catastrophic for shipping, of course. And number three is that the reality is we're down about, 8, 9, 10, 11 million barrels per day, which are just simply not coming out of this region. Now, is this a problem of stocks or production? Not really. It's really a problem of flow and transit. So the key thing to keep in mind here is that oil infrastructure is more or less still functional, more or less. There's been a few bits of damages, but the issue here is really one of flow. It's not really of stock or production. So the issue here is the market will only ease when this is cleared, when this stops. And at this point, I don't see any particular on-ramp. I was just reading even like 5 minutes ago, the Israelis, massive bombardments of Iran and poor old Lebanon as we speak. So the point is, and yesterday, the Secretary of War in the US, Pete Hegseth, I never know his name, Hegseth, basically said that yesterday would be the biggest day in terms of ammunitions and armaments. So the point is that if Trump wants to call a ceasefire, and he is giving a little bit of rhetoric here and there, the reality is that it doesn't seem to be happening anytime soon. All right, so let's just look at the price here of oil. Again, very, very volatile price action, based on a lot of the headlines and whatnot. But essentially, oil, once I can scroll down to it, here we go. So CL1 contract. So you can see here that we had like just an extraordinary amount of volatility yesterday. But what's happening today is that, it's been bouncing up in a range. And let's put it on a 30-minute chart just to get a little bit more detail. So we see that oil overall came down a huge amount yesterday, based on the headlines that there's going to be a strategic petroleum reserve release of which we'll get to in a second. But then there was the whole thing that the Iranians saying, no, 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 we're actually going to put mines in the Strait of Hormuz to blow up sort of tankers potentially. So essentially now I would say that we seem to be in this range of, sort of seems to be capping out at about $91, $92. And the range seems to be going down, about $10, $15 down into maybe let's call it the 80s, something. So sort of approximately between $80 and $90 seems to be the range. But the point is, as I was saying yesterday, is that before this conflict started on the Sunday, I think it was like the 1st of March, which is back all the way down here, you could see that oil was trading on the Friday there at around about 67. So whichever way you cut the cookie or slice the cake, or whichever cliche you want to use, you can see that just as we speak here at about almost 7 o'clock on March the 11th, 11 days after, the oil price is up about $17 or 25%. So whichever way you look at that, that is significantly more expensive. Now, what are we expecting today, apart from some tea? We're expecting there was a lot of negotiation in the last few days. It's kind of a formalized process of the IEA is going to announce that for the G7 countries, might be doing a coordinated release of reserves. So yesterday, apparently, Japan is pushing very, very hard. Japan is very, very affected by this in a negative way. So Japan is pushing very, very hard for a significant release. But yesterday, for various reasons, France and Portugal were less keen. So there was no sort of resolution yesterday. But apparently this morning at 1300 GMT time, which translates to 8 o'clock on the East Coast, so New York sort of time at 8 o'clock, there will be an announcement by the IEA, International Energy Agency, essentially as to the magnitude, and actually they're just confirming that there will be a strategic petroleum coordinated kind of release of the countries. Now, I'm not going to go into details, but the reality is that China apparently won't be part of that. They may do it unilaterally. They have over 1 billion barrels of their own as a strategic reserve. The US, keep in mind that the US reserve is quite degraded under the Biden administration. About 180 million barrels were released in 2022. So it's not unlimited. But what the market, and just by way of comparison, during 2022, when the Russians invaded Ukraine, about 182, let's call it 180 million barrels were released. The numbers being talked about, there was a Wall Street Journal article, the numbers being spoken about for release this morning is between 3 and 400 million. So approximately twice the size of the release back in 2022 when the Russians invaded Ukraine. So the question is, oh, that's going to solve everyone's problems. Not exactly. Now, if we get so first of all, keep in mind that the consensus is between 3 and 400 million. Anything less than that, I think would be quite a nasty disappointment to the market. Anything, 300, 350, 380, 400, I think, would be welcome within the market, but I would say it's almost priced in. I mean, keep in mind that we have had a significant reduction of oil over the last 48 hours. But could we get a little bit of a fall in the price of oil? It's probable, maybe $3, $4, $5, something like that. But then the issue, and of course, if we got a lot more than that, 500 or 600 million, that would definitely be welcomed by the market, and we could get a substantial fall back, maybe even into the mid 70s. The problem here is that, as I say, even if they announce 300 or 400 million, this is a question not of inventory or stock or production, but of flow and transit. So the problem is that even if this, large number was released, what I've been reading just over the last sort of 24 hours is that apparently this is going to take, at least in the case of the US, probably 7 to 13 days to actually get to market. this is a very complex process. There's bureaucracy. It needs to be released. It then needs to be transported. Contracts need to be issued. Who's going to buy this? Then it's going to be transferred. So the point is that this is not, oh, suddenly, a flood of 300 million barrels onto the oil market. This is something which realistically is going to take probably 7 to 10 days to actually get to market. And the numbers we're talking about is maybe 1, 2, 3 million barrels a day actually being released between the US and the other G7 nations. Now, is that good news? Is that welcome for the oil market? Yeah, for sure. But as I say, the market is apparently in deficit about sort of 8, 9, 10, 11 million barrels per day at the moment. So if the Strategic Petroleum Reserve releases from the G7 today can bring another million or 2 or 3 million barrels to the market, that's good, but we're still going to have a shortfall. And the longer the Strait of Hormuz is effectively closed for traffic, that's just going to build up every day by 6 or 8 million barrels per day of a shortfall. And that means the elasticity is kind of going to snap, and we're going to start getting higher and higher prices. So I still think that these prices could go higher, unless, of course, we get some sort of cessation in hostilities. So that's the thing. But anyway, let's keep an eye on that. That's going to be at 8 o'clock this morning. So that's going to be very, very important. We also have today just a couple of other things keep in mind. Well, let's just look at some of the markets. Well, first of all, we have the CPI, which ordinarily would be getting all of the sort of the attention. But the point is that this is pre sort of Iranian sort of war, and therefore we all know that the energy prices have spiked. But let's just have a quick look and see what's expected. We can see here that the month-over-month headline number is expected to come in at 0.3. Which is probably, okay for the Fed. They would prefer it at 0.2, but 0.3 is, a little bit too high for them, still sort of sticky. And then probably the most important one is the core number. Where do we have that? The core month-over-month number, 0.2. So that's what's expected. In terms of the Fed, I mean, in terms of the central banks, we had some fairly hawkish commentary yesterday coming out of the ECB. We also had Lagarde herself at a speech saying that she would not allow the mistake of nasty inflation which happened back in 2022-23 to occur. So Lagarde herself is saying, that she's very much sort of focused on not allowing this energy spike to cause inflation. But in terms of the reaction today, I think it's going to be relatively muted, just because, unless it's crazy, like 0.4 or something like that, 0.5, just because that will add fuel to the fire of the energy sort of induced inflation. But as you can see here for the next Fed meeting, the probability of a cut is essentially zero. If we go out to let's say even out to June, you can see that rises a little bit. So about a 34% chance of one cut. Still, the market's still fairly conservative. And let's say looking at the December meeting, you can see here that the chances of 1 or 2 cuts definitely go up. But there's still a 17% chance of no cuts. So as we all know, the bonds over the last few sort of period have moved much more to reprice hawkishly. So let's just look at a few yields just quickly on that. Where are we? US yields. So if we look at, let's say, the 2-year yield here, you can see that it went down for a couple of days, let's say on but over the last couple of days it started to push higher again, and still quite elevated. And you can compare to when the war started, which is down here on, let's say, the Monday. For the 2-year, we're down at about 3.38, and as we speak at 3.6 essentially. So has it come off its highs? Yes, but still pretty elevated, and there's still concerns. And then if you look out at the 10-year, a similar kind of situation. It's come off its high point, which was 4.2, but still compared to the beginning of the war, much more elevated. And the same situation here with the 30-year. And it's also the same thing over in Europe. If you look at if you look at the 2-year here, it's if anything much worse, because Europe is more directly impacted. And you can see that the bobble, no, the Schatz here, you can see that at a certain point had gone up almost 50 basis points. It's come back down, but still since the beginning of the war, it's up about 33 basis points. And the similar kind of situation here with the bobble. And then looking at the Bund, for example, you can see that's very elevated. And then looking at the Buchsel, the 30-year, that's actually at new highs. So the Buchsel yield ripping much higher. So we're getting a nasty steepening there. So the point is that expectations for the Fed and the ECB to cut have definitely come down. In the case of the ECB, there's actually a hike by the end of the year has been priced in. So what can the CPI do today? I would say it's a bit asymmetric. I think like like an inline or slightly lower than expected CPI would be discounted. The market would say, or would be ignored. The market would say, hey, that's irrelevant because basically that doesn't take into consideration the situation in the energy markets. On the other hand, a CPI which came in on the hot side today, I think could, as I say, to use a pun, could fuel the fire, throw gasoline on the fire, and really give the market sort of the heebie-jeebies about the possibility of an inflation spike and a much, much less passive sort of Fed. So, in terms of what's going on, if we look at the sort of FX, the dollar, as you can see here over the last couple of days, pretty sort of stable at this point, just waiting probably developments from the headlines. Well, we can start to pick out a few winners and losers. It's interesting to look at the Aussie dollar here. Now, of course, the Australian dollar is a net exporter of energy. We also know the domestic economy is doing well, and we've had some hawkish rhetoric from the RBA, the Reserve Bank of Australia, recently. And you can see here that it's actually breaking out of this range. I mean, it's been very strong now for a couple of months, but apart from the initial sort of geopolitical shock and the risk-off tone, the Aussie dollar is clearly where sort of some money is going. If we look over at New Zealand as well, you can see not so much because New Zealand does not export energy. What has also been a very good performer has been the Canadian dollar. This is against the US. You can see here the US dollar has shown weak. So the US dollar has been strong against most currencies, but against the Canadian dollar, it's actually shown quite a lot of weakness. And that's because obviously Canada, much like Australia, is an energy sort of a big energy importer. So for the terms of trade, that's a positive. On the other hand, if you look at China, Japan, they've been pushing very, very hard to get some of the strategic petroleum reserves released because they, as we all know, import, I think it's almost like 100% of their sort of energy. So you can see the US dollar here pushing a lot higher against the yen. And this is causing problems. Maybe the Bank of Japan will have to hike to actually kind of contain this inflation, this sort of energy-driven inflation, which potentially could have some effects on Japan on the stock market. So if we look over at, let's say, the Nikkei, that's been under pressure because this is not great news. Let's have a look at the Nikkei over here. So you see the Nikkei here has been under quite a lot of pressure, had a little bit of a bounce, but this maybe is this bit of a sort of a dead cat bounce, just a Fibonacci sort of bounce here. And if this oil crisis continues to continues, then I do believe that the possibility of the BOJ hiking more quickly than they would have liked is going to be a negative here for the Nikkei. So we could start to see that index under a bit of pressure. Just while we're over in Asia, if we actually look at the Kospi in Korea, South Korea, you can see that it's had a bit of a recovery, but still off the highs. And of course, that is a lot more affected by what's happening in the semiconductor space. But still, Asian markets are under pressure. The same thing with China here. Now, talking about the US, we have, again, you can see this on the daily chart, just a lot of intraday volatility here, no clear direction. It's going to be difficult for these markets to rally substantially when there are concerns about the geopolitical concerns, but really the real concerns is that a much higher sort of energy prices, inflation, a less accommodative Fed is going to basically weigh on global growth and maybe, even eventually US domestic growth, although the US is much less directly exposed than, let's say, something like Europe. But until we get the all clear, some kind of ceasefire or de-escalation from the White House, and also it will require Iran to say the same thing. So this is the other issue as well, is that it's not only Trump saying, hey, I'm happy with the situation, as is really we need the Iranians to sort of, in a certain sense, quote unquote, agree with that and to withdraw their threats of mining the Strait of Hormuz. And we need to actually see those tankers moving. That is what we need. So at this point, we're almost even beyond unilateral rhetoric. We actually need to see the oil prices coming down because the Straits of Hormuz are sort of actively reopened and the oil actively flowing outwards. But once we get that, could the US market push higher? Most probably it will have a large relief rally, which is not the case over in Europe. We still see that Europe is under quite a lot of pressure. You look here at the FXXP, which is the Euro Stock 600, still under quite a lot of pressure. So we're still seeing Asian markets under pressure, European markets under pressure. And I'd say in the US, it's a slightly more nuanced situation. It's just sort of in a holding zone. It's chopping around on headlines. It doesn't want to collapse just yet because the underlying economy is still, for the moment, quite good. If we just look at some of the subcomponents, we actually saw yesterday the software ETF just having a bit of a pause because it had a nice run up. If we look at the semiconductors, that actually was pretty strong. If you look at the Mag 7s, also doing okay. So, the Mag 7s, maybe they a little bit of a safe haven at the moment. It's possible. In terms of other stuff, as I say, today, just want to be keeping an eye on the Aussie dollar, the yen, obviously on oil, and the CPI numbers, and the bonds. Again, I think the bonds, if there is sort of hot CPI, definitely I think we could see that, even a little bit more pressure coming into the front end. But, we're getting to a point now where, it's been the ZT here, for example, has come down a lot. So I think, we may be getting to the lower end of this range. And if we get a inline or even a slightly benign reading, there could be a possibility of, a bit of a short-term release, maybe, 4, 5, 6 basis points. That's something to be looking at today. Other issue as well today, we have a 10-year auction. Interesting to see global demand for that. There was a sort of a weak auction yesterday. So let's see how today's auction goes at 1 p.m. So that's about it, guys. We'll keep an eye on all the headlines. And as I say, the main thing in the short term will be at 8 a.m. in just over an hour. We will have the IEA's recommendations. As I say, the market is expecting or hoping for between 300,000 and 400,000 barrels. Anything less than that would be a disappointment. Anything more will give, I think, some temporary relief. Okay, have a great day. Thanks for that. Hope that was useful. And I'll be back tomorrow morning with the macro snapshot. Take care. Thank you.